Hey guys, Max Convexity. Welcome back to my channel. Jax is looking at me. Jax, it's all right. I have to do a YouTube. I'm going to do a video real quick. All right, guys. I want to talk about some option trades today. I'm going to suggest a couple of option trades. I'm not really going to suggest them, but we're going to talk about them just to illustrate some key elements of options. But the meme trades are interesting to me because in options, when you're an option seller, you're selling volatility, you want to find the stocks with the super high volatility to sell. Not only that, with super high volatility and high volatility that hopefully isn't going higher. Because sometimes if you sell and when you get into a situation like GameStop and it gaps up a couple of times and you think the premium's so high and then you sell it, it keeps going and it runs through you and it makes a loss. You don't want to, on GameStop, to be the challenge on meme stocks is to invent a system that monetizes the high premium, or invent a trade that will take advantage of the premium those options are paying, but not have you capped out on the upside. So that's the challenge of it. So I have a trade that I like to do on these types of stocks. It's also a long volatility trade because also on these types of stocks, you want to be able to also make money if volatility keeps going up. If you do like an iron condor, where you sell a call spread on one side, a put spread on the other side, on GameStop, and you get an obscene premium, and then tomorrow it gaps up again, and then it gaps up again, your iron condor will be a loser because of the bullish side. It'll run through the strikes. Or, an iron condor on a meme stock could even be a loser on the bearish side if something happens in it collapses or something. Robinhood removes the buy button or something and it goes the other way. I just think there's too much risk in these income type strategies that have risk on both sides. So I'm going to give you guys what I think is a better way to do it. Okay, so first of all, first we're going to start on GameStop, and I'm going to build it from scratch because I want you guys to see my thinking process. Then I'm going to show you a trade I've already put on for FFIE. Okay, so what we're trying to do here on these types of trades that I call a straddle strangle swap, I call it a straddle strangle swap. These guys call it a double diagonal. Okay, so you have to hit double diagonal. It's the fastest way to get started on it. Okay, build a double diagonal. Okay, so, but what a double diagonal is a put calendar and a call calendar together. So a put calendar is where you sell a put in this week and you buy a put in the following week. Call calendars where you sell a call in this week and you buy a call in the following week. Well, you can do both of them together and you can make a double calendar, and it gives you a payout profile kind of like an iron condor where, it can go, the market has to go way down. This is very similar, profile to an iron condor. Watch this. We'll do it like this. We'll build it over here, and then we're going to build. And I'm not knocking iron condors. I'll just use an example. So there's an iron condor. And there is the double diagonal or the straddle strangle swap. So what I like to do, first of all, okay. What I like to do, first of all, is look at these call options. This is what you're trying to do. Look at the IV on this call option. It's going for $4 and it's 6 points out of the money. It's a 475 IV. That's ridiculous. So you're selling that call option. So you're short that. You're monetizing that 475. You're bringing that in. So you're turning around and buying this call option at 390% at a less volatility. This is a statistical arbitrage type strategy also. Okay, so now I'm going to move the strikes around, and we're going to look at the profit and loss graph change in real time. Then I'll explain afterwards what I did. But what I want to start with, here's what I want to try to, here's the point I'm trying to make. This option expires on Friday. It's worth $4.25, 6 points out of the money. That's obscene. Here's one that's 10 points out of the money that expires Friday. That's $3.50. It's a 508 fall. That's obscene. I mean, it's ridiculous. If this was a covered call, we would want to sell that call. But anyway, I'll explain the covered call scenario in a second. But yeah, that's ridiculous. That's obscene. Okay. All right. So now I'm going to move the strikes around because I don't want a loss. If the market goes, if this thing goes to 200 tomorrow, which it could, it's a meme stock, or 100, I don't want to lose money. I just want my loss to be if it goes down. Okay. So what you can do there is you move the call you buy back a little further. This is called I call this the consolation price trade, because you're going for a result right here in the middle. You're going for up 30%, up 20%, up 10%, down 10%, up. You're going for this result. It's a consolation price because if it starts running the other way, you still make some money. So, and really you can also, it's how far you dare to move this call out. Look at this. Let's try the 45. The 45 is a 528 fall and is still bringing in $2.96. We could sell the 45 and buy the 40. Consolation price would be $370. The market goes nowhere, we'd make $279. The market has to drop further than 23% before we lose money. We have $600 or $700 at risk total. But we're hoping for the market to go up a few more days. And max profit would be right where this option is we sold, the 45 strike, right? Okay, so anyway, I think something like that would make a good trade. Now, if you look at these, now on the puts, we can adjust where they are too. Because this put right here on the bottom is we're selling this put. That's $2.10, and it's 5 points under, out of the money. That's a 348 fall. We can move this closer to the money and bring in a little more. We can sell it right at the money and bring in more money and more IV. We just lose a little bit of our buffer. Now our buffer is only 19% on the downside. But we can move this one in as well. All right, so we could sell the 30 put for this week and then buy the 30 put in the following week just for protection, just to keep us from having I'll show you why in a second. Okay, market goes nowhere. We should make about $476. All right, this is what we're going to do. This trade right here. We're selling the 30 put and the 45 call. The 45 call, we could sell it for $3. The put, we could sell it for $470. So we're bringing in $770. Then we're going to buy this for $575. We're going to buy that call. That's going to be our moneymaker, hopefully. Then we're going to buy this call at $6.50, which is kind of expensive. But anyway, that's just our insurance. But so you can see we've set up a trade that is actually a long volatility trade. Usually most option trades like a calendar spread is short volatility. Here's another advantage to this. Volatility collapses tomorrow. If volatility collapses tomorrow on the iron condor, that's actually what you want because your price is locked in. So that's why it's considered short volatility. You want short vol. You don't want you don't want the prices to, if volatility expands, then it's an opportunity loss because you could have sold your iron condor the next day for higher. You want to sell high and buy low. Okay. On the straddle strangle swap, watch this implied volatility. This is actually long volatility. If volatility goes up, this trade becomes more profitable. In fact, if volatility doubles, it almost makes it where it makes your buffer 50%. Now, that's not likely, but that can happen sometimes on meme stocks. We want to be on the long side of volatility. We want to be long volatility. We want to profit if volatility goes up. So this would make a damn nice trade. Now, let's talk about the dangers of it. Volatility collapses. Now, this trade expires Friday, so it's only a few days away, but volatility collapses between now and then. Let's knock about 10% off it. It was at 440, so we'll make it 380. Okay, so you knock 10% off it. It makes the go nowhere price a little bit less. We're only going to make 361. If it's even lower, I don't think volatility is going to go down that much, but for some reason it did. That's your risk because you're long volatility. This is a long volatility trade. You're long volatility and you're neutral on direction. So yeah, so that's what you don't want. That's what you don't want. That's what we're playing against. But even if volatility collapses in half, still $150 profit, and the market has to move 10% against you before you lose, and the most you can lose is $500 or $467. I think this is a pretty good trade. Let me tell you why I like this better than a more typical way to do this would be a more typical way to monetize this would be the way ULTY does it, and that would be doing a covered call. And why I just want to show you real quick. Okay, so a covered call, we could do the same thing because remember, we're just trying to monetize this 45. These other three options are just for a hedge, basically. We want to monetize we want that $2.90 in our bank account or in our brokerage account, in our Tasty Trade account, in our Thinkorswim, right? Okay, so that's basically the trade there. The rest of it you could be called is synthetic stock. Just think of it that way. It's synthetic long stock. It loses if it goes lower. And anyway, all right. So one thing I want to do is put the volatility back up. It doesn't look near as appealing. So here's the volatility. But even if the price doesn't go up tomorrow or only goes up 10%, but the volatility goes up a little bit, you can see you make money. You make more money. I did two of these with real money the last time GameStop blew up, and I made some content on one of them. I made $600 or $700 on the first one. I did one just like this. Market was up 20% the next day, and volatility was up. But I didn't hold till expiration. I held, it went like that. Time passed, and it was up like $500-$600. I sold it and rolled it and put another one on in the next week. Well, that one lost, but I bet the same amount on the second one as I made on the first one. So it was a break-even trade. I had a free shot at, another week. Anyway, we'll see what happens. You guys think this volatility will last in the market one more day? I mean, if this is just a one-day deal and this stock's going to collapse tomorrow, this is going to be a losing trade. Even after you figure in, or it has the potential to be a losing trade, because if it collapses tomorrow, let's say that it comes out tomorrow and the SEC says they're going to make it illegal or it's just something stupid, but for some reason this is going, volatility collapses on this thing. So if volatility collapses and it drops at the same time, if it drops 20% and volatility collapses, you could easily lose $220 overnight, if not the whole 500. So just be aware of that. But these trades are good little trades, and I'll do some more content on them later. Okay. On FFIE, it's a variation of the same trade. Here, I'm going to save this in here. I haven't done this in real life yet. I'm going to do this after I get off with you guys. Enter a trade pretty close to this in my Tasty Trade. So I'm going to say here, meme trade long vol. All right. So we'll see. I'm going to save it in here just so we can see how it does in here. Now, the View Safe Trades, FFIE, is another meme stock. I was on Reddit and I heard them talking about this one. It stands for Faraday. I don't even know. I'm sure you guys know. But it's it has stupid high volatility right now. So on this one, we're going to do a three-legged spread. There's no reason to buy the protective put on the downside because it's only trading at $1. It's 64 cents. So we can only lose down to zero. Okay. So on this one, we're going to sell the put. We're going to sell a put and a call for this week that expires on Friday. Okay. So the put we're going to get 44 cents for, which is obscene. That's 636%. That's obscene. We're getting 43 cents for $1 put. So that means we have to agree to buy something at $1, but it can only drop to zero. And we're getting 43 cents for it. So the maximum risk on this trade, if a zombie apocalypse hits tomorrow, is 57 cents. That's the most we can lose. Well, we've cushioned that a little bit by also selling a call. We're also selling the one strike price call for 7 cents. Okay. So we're bringing in 50 cents right there. Then we're going to take that 50 cents and we're going to buy these $12 options, 12-cent options. We're going to buy 3 of them. So that'll cost around $36. So we can put this trade on for a credit. Okay. So this is a straddle strangle swap also. Like I say, it's just missing the put. And on this one, I added extra long legs to it. That the other one had one contract on all legs. This one is actually a triple long straddle strangle swap. Anyway, because what we really want here is we want this to blow up. We want this to go to $2 or something. If it goes to $2, we're going to make $166 on that. That may not sound like a lot, but let's look at the alternative. If you did it so basically this 1.5 calls what we bought, right? If you did it instead of doing the synthetic thing and all this stuff, this three-legged monster, if you just bought this, you could just buy this call, and I illustrated what that would look like. No, I didn't. I messed it up. Oh, here it is. Yeah. Okay. So what I did is I eliminated these. I excluded these. So this is what happened if you could just buy this call and it's $33. All right. But the problem is, look, it has to go from 64 cents to where it's at now to $1.60 till you break even. Even if it goes to $2, you just made $116. If it goes nowhere, you lost $33. Anyway, I like the looks of this one better. This one also is long volatility. This is the first day of hopefully what will turn into a multi-week meme stock explosion, or who knows if it does or not. But anyway, if volatility goes up tomorrow, same thing. If volatility goes up 20%, it makes it where the break even gets lower. I mean, this is a real powerful trade. I've already put this one on in real life, or one similar to this. My fills are a little bit different, but I did this morning. Anyway, I'm just hoping, but this is an easy trade. I'm just hoping for it to go up. But the thing is, if it doesn't go up and it stays sideways, I don't lose $33. It may not seem like a lot, but let's say it only goes up 25% tomorrow. I still make money, where the other way I wouldn't make money until it went up 100%. So anyway, these are the types of edges I like to exploit with options. I know this is a small trade. The beauty of it is you can do this 10 times with not a lot of risk. I put it on 10 times. I have about $500 risk, but I'm going to make several $1,000s if it blows up, and I'm not going to, and if it goes nowhere, I'm going to minimize my losses from theta decay, because I've sold options to be able to afford to buy this option. Okay. One more thing here on this GME trade. Here's what I was trying to compare it to. If you did a covered call and you sold, what did they sell? It was the 40, right? I already forgot what the trade was. Yeah, it was the 45. Okay. It's a great trade. You could buy 100 shares of stock and sell this 45 option. And that's another way to do the same trade. It's another way to monetize the same source of income, because you want to get this IV in your pocket, this 526% IV. You know, you want to get that in your pocket. We could even maybe get the 50. Look at that. The 50, the bid, it's only a 6-cent spread. My gosh. Anyway, but just in theory. So this would be a more typical way. Like if ULTY has it in their portfolio, and they do at times, maybe they do now, that'd be great. But if they had it in their portfolio, they would do this. They would buy the shares or get a synthetic. It wouldn't matter, and sell the 50 to monetize, or sell whatever call I sold. I think I sold the 45. Anyway, you can monetize the same thing with a covered call strategy is my point. Covered call strategy, what does it expose you to? What do we know about it? It exposes you to not all the risk on the downside, but the vast majority of it. Okay. It triggers me when people say all the risk, because it's not all the risk, but it exposes you to a lot of risk. So this strategy right here, I just, I just prefer, I meant to keep it open in both tabs, but I prefer the way I did it. Let's do this. Let's go like this, so we can get them side by side. Medium long trade. Okay. So the GME custom trade. Okay. Okay. Yes. So, my way, if something really bad happens, you lose $500. The other way, the covered call way, and it's fine if you have a bigger account. I mean, but something bad happens, you're going to lose about twice that much. A 1 standard deviation move down, you lose $1,000. The way I did it, you lose 300. So or 378. So let's do a little experiment here. Let's leverage mine up, or not. Let's size it up, not leverage it up. Size it up and try to make an equal comparison and see. I don't know how this is going to turn out. Maybe this will make us want to do it the covered call way. Okay. So there it is, sized up. I try to make it, a 1 standard deviation now costs you 700, 1100. Okay, well, to make it even, it'd probably have to do this. Just trying to make, I love apples to apples comparisons. All right. So yes, 1 standard deviation move, you have the $1,100 loss. Okay. I will say on a 2 standard deviation move, you only have a $1,300 loss. And on this one, on the student, the further move, I don't really see the 2 standard deviation line on this one, but it's a bigger, you have more black swan risk, and you can even lose all the way down to 0. The max risk on this trade is about 3 times what it is on the other trade. All right. Well, now let's look at the other side of it. Let's look at the profit. This trade, a 1 standard deviation, which is the first dash mark, move up, make you about $1,500. 2 standard deviations make you $2,100. Okay. 1 standard deviation my way makes you $2,700. And makes you $1,800, and you don't have any. And even at a minimum on the upside, it looks like the consolation prize is around 960 or something. It looks like about 800 is your consolation prize on this method. So I don't know. Different strokes for different folks. The covered call strategy. Also, because here's where the market trades, the covered call strategy gives you a 7% downside buffer. The straddle strangle swap, the max convexity straddle strangle swap strategy gives you about a 17% buffer. 17% buffer, less black swan risk, more profit at the 1 standard deviation. Let's see how much it moves if it goes nowhere. The go nowhere profit. This one would be $1,300. Yeah, and the covered call would be $200. So I think my strategy is a winner. I think it's not my strategy. I didn't invent the double diagonal, but I think that this way of using options, to use a double diagonal to kind of simulate a covered call or an iron condor, kind of simulate the best qualities from each of them, really, because we're going for this 45 call. We want that money in our account, right? See, and it was the 45. So to make an apples to apples comparison, I need to switch it back to the 45. Okay. So for apples to apples, it's on the 45. So the go nowhere price is $250. The go nowhere price the other way was 1,700. One standard deviation downs, lose 1,000. Two standard deviations is lose 1,700, which is very similar on the two standard. Well, I hope you guys like this stuff. If not, surely you've tuned out by now. So, but I'm hoping the ones that you guys that are still left are enjoying this and will tell me what I'm missing about this. How do you guys have a better way to do it? I'm sure there's lots of better ways out there to do meme stocks. You can also use this strategy on earning stocks because it's the same theory. It's a high volatility strategy. And I've made some videos on that on earning stocks as well. But yeah, I just think this compares favorably. The go nowhere price is more, the one standard deviation price is more, two standard deviation price move. Let's see if it's more. Here's the second. Yep, 1,900 compared to 1,700. I don't know. Like I say, I appreciate you guys. I'm going to let you guys get back to it. I want to put this on before the market closes so people can go look at this in real time. I'm going to go put on something very similar to this. The markets are moving around. That's what I'm saying. It may be a strike or two off, but I'm going to put on something similar to this. I think we have another week. I'm hoping we have at least another day or two in us. One thought about technical analysis. I'm big on talking about gaps and momentum and all kinds of stuff. But the gap rule today, we had a big gap up on GameStop. Okay, the rule is if the gap isn't filled, meaning if the price doesn't come back to touch the bottom of it pretty quick. There's no rule on what that means, but I'm going to say within a day that you're supposed to go in the direction of the gap. That's usually a sign that the market's strong if it's a bullish gap. Anyway. So it doesn't look like it's going to fill by the end of the day. So I'm going to say also that maybe we get, I'm hoping and thinking we get another gap up tomorrow, in which case I'll probably take my trade off for a big profit. We'll see. But in worst case scenario, I'll leave it on till the end of the week. And, and I feel like I feel like both trades are strong trades. And also compare favorably to other type of income trades. Like I say, I believe that the covered call is the granddaddy of income trades. And I believe this way works better on meme stocks. So I don't know. Let me know what you guys think. I appreciate each and every one of you guys. And I will talk to you after the market closes.